Good evening. So it's an honor and a privilege to be part of this event and also interview Shri Govind Parikh, who's one of my mentors and role models. I'll briefly introduce Govind Bhai Parikh. So he's a chemical engineer by profession, but destiny had plans that he got into investing right as his first career. So I would not hesitate to call him the Warren Buffett of South India. So he's extremely long-thinking, quality-oriented investor and has achieved very well in spite of being a kind of a boring investment style. He has coined investing mantras, I would say, called as sleeping point investing. It means we'll understand more about sleeping point investing. And he has something very, very powerful called as bear market buying power. We'll also understand more about what's this bear market buying power. He has two very, very smart sons. He's an avid golfer, so that's very interesting. Ashish, his first son, is an accomplished techie himself, based in Bay Area in US, and has over 24 or maybe more patents to his name, Ashish. Chinmay, his second son, is part of Chennai's investing community, a close dear friend. I think he's around here. He's a alumni of Carnegie Mellon University and is now actively involved in managing the family office. And Govind Bhai feels, and I also share, that Chinmay is probably a smarter investor than Govind Bhai himself. So welcome, Govind Bhai. Pleasure and honor to host you in this. Before I start, I want to thank the CFA chapter for hosting this event. I think it's a very apt event. A lot of wisdom from Shri Govind Parikh. I think it's a very, very good event they have put together for the Chennai finance and investing community. Before I go over with the formal interview, I want to express my gratitude. I left my full-time consulting career to be a full-time investor. And the doyens of Chennai's investing community, primarily Shri Govind Parikh, Rajiv Khanna sir, who's here, and several others, I think they have motivated me and several other people here in the audience, encouraged, motivated, supported, you can call what you want, budding investors. So I think I've seen an active encouragement of us. So thank you so much, Govind Bhai, and also Rajiv Khanna sir. There is a Buffett saying that be fearful when others are greedy and be greedy when others are fearful. Heard that? Sounds very simple, but it's very difficult to do. And I'll narrate an incident which I have seen with Govind Bhai exactly on this. So it was mid of March 2020. You know what happened? COVID was just about starting. And so we have a partnership and all our partners are here. So we were all confused what to do because it's a once in maybe a lifetime event. Markets were crashing. Of course, they were discounting the worst as the event was unfolding. So we all went to him to seek his guidance and more than that, perspective. Okay, what do we do? What can happen? It looked like everything will go to zero types. So it was trading hours and he was happily buying stocks. He said, "Nahi, it's a very good opportunity." He was buying. And in fact, in the middle of the conversation, he said, "I've just put a fairly sizable order for State Bank." And I remember it was about 200 or 210, 220. So, or maybe lower.
Yeah.
So I want to start by asking what's the framework which makes you buy? Because most of us panic like deers in front of a flashlight. So what's the framework or the model which makes you deploy capital during that time?
Okay, thanks Vijay and thanks Naresh. And I sincerely thank the board of directors who come from Calcutta. Jitendra ji is from Delhi, right? And I'm a great fan of this CFA Society. And last couple of years, Navneet Munot and even before that Sunil was there. So Navneet has been telling me that you come and speak. I said, look, if I have to talk to a Lions Club or a Rotary Club, I can speak something, Okay, I'm not a finance guy, and they are all studs, So it will be very embarrassing for me to speak in front of them. Then he said, no, you come and speak, give your experiences. And it couldn't happen last time, but then this time Sriman suggested that we have a smaller chapter, only 30 people like that. So you speak here. So I came here, and thanks for your kind words, but it's actually, to be very frank with you, there's a lot of element of luck matters, and who are all your gurus, it matters a lot. If you've learned it the right way, then probably you will not go off track very easily. So my Guruji, Sri Kishan Choksi, and my uncle Naresh Khanwala, they've taught me what is long-term investing. So coming to this COVID situation, COVID was almost like a war, It was a war without an enemy, visible enemy, War without a single bullet being fired. And, it was also very, very difficult to see and very depressing to see a lot of people unwell and a lot of people passing away, good friends and all that. In fact, my house, other than me, everybody else had COVID. And virtually everybody had COVID. And the markets were coming down quite strongly. I mean, people were thinking that there's no end to the world. And what we were thinking, Chinmay and I, we were continuously telling ourselves that, look, valuations have come to a level which is a compelling buy situation. So we thought maybe it will stop at around 10,000. That was the bottom. So we started buying it from 10,500 downwards, 10,000. And then, as it happens every time, it started going down further and further and further. And we were continuously buying. Because it was more a health crisis. It was not a financial crisis. And there was so much panic in the market. So I told myself two things. Suppose, it's the end of the world, then nobody is there. But for some reason, the advanced countries or India, or people come out with some drugs or vaccines and things improve, then you will never get this kind of shares. And very luckily, the market also, government had also allowed a lot of companies, a lot of industries to function during lockdown period. So some of those shares those companies were doing very well actually. They are very good companies and all. But the market doesn't care. Market doesn't know anything. Market is a jungle with different people, different animals, like thinking differently. But everybody at a time wants to sell. And then, so we started buying. We bought from 10,000 to up to 8,000. And then after that, we had still about 30% of the total cash left. We invested about 70%. Because very honestly, nobody knew when it's going to end. So yeah, that's it. That's what made us buy.
Interesting. And what happens like these? I'm sure it happened in 2008. You buy and it continues to fall. So how do you handle that? I mean, that's because your existing portfolio is falling. What you buy is also falling.
No, each time is different. 2008, actually, we were not keeping too much cash.
Okay.
After 2008 crash, we realized that we should always have some cash with us. It's like keeping an ammunition,
Wow.
When in whatever happens. Primarily, we don't borrow and invest.
True.
So, and our liabilities are not there. So it's very comfortable to, and our lifestyle, by God's grace, even my children also, my wife and my daughter-in-law, all of them. So it's not that it's too flashy for us to keep generating more and more money. So it was okay. If market came down also, it was, at the end of the day, a paper loss. Because eventually, good companies, if India had to grow, good companies will definitely grow. They'll grow much, much faster than the others.
And will bounce back stronger.
So that is why we got.
Perfect. So let me start with your early investing career. I think it started probably 4 decades back. So how did it start? Because Chennai was generally a kind of backwater. There was not active investing research being done. It's all only centered in Bombay. So how did your investment research and investment analysis career start?
Okay. I was doing my engineering from 76 to 81. My classmate Prakash Sarog is also here. He's a brilliant student. For the first 3 years, I was also doing reasonably well in studies. Not as good as him, of course. But after that, my sister got married in Bombay in 1977. So I had gone to, I visited her, and my sister and brother-in-law, they took me to Kishan Choksi's house in the night. So before that, we had bought some shares on advice of my sister's father-in-law, some 5 Bajaj Auto and 100 shares of kinetic engineering kind of thing. Kinetic was not there, I think, Bajaj Auto and those kind of shares. So I was always interested in knowing about the market. So casually I told Kishan Bhai, that how does the stock market keeps going up and down and all that. So Kishan Bhai said, look, he told my sister and brother-in-law, you go home, I'll get him dropped. After dinner in the night, he took out an annual report of Bajaj Auto. And first he told me about the company. So this company has got 10-year waiting list. So whatever they produce, they will sell. There is no question of there any selling difficulty and all that. And second thing is, now they've got a license to double their capacity from 80,000 to 160,000 tons.
So this was the license Raj days?
It was license Raj days, right. You're right. So, and the news had come about 10 days back in the newspapers everywhere. And the stock also went up with the news. After that, people forgot about it. They were looking at some other thing, So there were very few people who were doing real long-term investing. So one was Kishan Choksi, another person is Hemendra Seth, Utpal Seth's father.
Oh, wow.
He was also a great analyst and long-term investor. So Kishan Bhai suggested that, he was telling me how when the capacity doubles, the profit is going to double, the stock price also double. Wait 2-3 years, but it will double. So that's how he taught me how to read an annual report. Little bit, in the initial days I didn't know much. And then, but I used to make sure that every time I used to go to Akurdi to visit the plant along with them. It was like a picnic. From Bombay, everybody used to go to Bajaj Auto AGM. And it was a pleasure listening to Rahul Bajaj and looking at the factory and all those things. Because what we studied in engineering is not, this kind of thing. So from then on, I started investing, and I then thought that I came to Madras and I found that many brokers were looking at more, they were catering, some of the senior brokers were catering to Bombay institutions and all that, mostly the institutions. And some other new brokers were more interested in short-term trading. So that's how I invested. I thought I should become a broker. And I love to read the annual report, whatever it is. Those days only director's report used to come. Now you have MDA and everything else. So that's how my interest took place in that.
Tell us about your early insights and successes in companies like Ramco Cements, or I think you had visited some factories and tried to learn businesses, which was not quite the norm. So how did it play out there?
See, initially there were two companies, Ramco Cements and LMW, Lakshmi Machine Works. So I like both the companies because the companies were so very big and strong. And I happened to see the Ramco Cement plant in 1979, I think. 77 they became dry process, and so we went and saw the plant. And the stock was available for a market cap of about 2 crores or 2.5 crores or something. And my broker told me there's a small lot available of 20 shares. So it's one certificate, not small lot, one certificate. So he gave it to me for some, $180 or something. So for 1.8 crore market
share.
Yeah, 100 rupees share. Yeah. For 1.8 crore market cap. Yeah. And I could see that, it's very, very, very strong, efficient company. So from Bombay, Kishan Choksi and my uncle, we went and saw went to attend the AGM. In those days, the AGM used to be only even now, it's in their village. The register office will be in the village. So not many people used to go. So anybody who takes interest and goes there, management is very happy. Chairman will sit like this, in his house itself, the AGM will be conducted.
Oh, okay.
And then Then also, we can see the factory also. They will take us to see the factory also and all that. So, I mean, it was amazing to see this kind of company available such as low price. So that's how we bought Madras Cements. And next year, Asit Koticha and then Nemisha, all these people, they came and I used to arrange meetings with the managements here. So they bought a lot of shares and, it became very popular share. ACC used to be 3-4 times Ramco Cement and then, it became other way.
So Ramco Cements, if I hear under 3 crore market cap, which is now probably 15,000 crore, so that's like a 5,000x without dilution. Did I get the numbers right?
Yeah, but you can't take it like that.
Okay.
Because compounding also you should see.
But they haven't diluted in the journey of 20-40 years.
They haven't diluted.
Okay.
And so it's a very efficient company actually, and it came into popularity because of my friends in Bombay. All these people in Bombay.
They started taking stakes in the...
Nimisha and others, they bought shares. And then it became, like Kishan Choksi, so many clients were there, everybody bought the shares. Sudhir Bhai also might have bought the shares, I remember in those days. So by the way, he's come from Bombay just for attending the meeting.
Wow. Interesting.
So, yeah, so that's how we invested in Ramco Cement. And also cement was becoming, more, it was a controlled commodity, then slowly there was a partial decontrol and fully decontrolled. So it was always a logistic issue in cement, If you have, in those days, if you have in a single location too many plants, I mean big plant, it's very disadvantageous because you send cement to distant places. So these guys had strategically had one plant and then another plant plants. They put like that.
Interesting. So I'll move to your investment philosophy. It's publicly known. You have several holdings which have 5, 10, 20, 50x. It's known in the publicly shared holdings. So I'm keen to know, like I personally do not have anything which is 10x, frankly. You have 50 or 100x. A lot of us have not had that. So what makes you, one, buy those multi-baggers, and two, hold on, because in between there would be demonetization, there would be financial crisis and war and COVID and whatever. So what's the framework to identify those and then hold on to them?
See, basically a couple of things. The first thing is we try to see that we invest in companies where the management is clean management and they are shareholder friendly. And the promoters also have a lot of passion, for running the business and growing well. And other thing is, these companies, they always, they looked after shareholder values and all that. And we never borrowed and invested in the market. So our philosophy is that, and we invest with a very, very long-term view, at least 2-3 years. And those days, I think if you can double your money in 3 years, it was pretty good. 2-3 years, it was good. Interest rates were also very high. So basic philosophy is that you invest for long term in quality companies and stay invested. And don't get worried about the day-to-day movement or some big crash. But keep continuously finding out what is happening in the company. Fundamentally. So I'll tell you an example. A friend of mine from Morgan Stanley had come. And he said that he wants to know about cement industry. He wants to meet Ramco Cement. I said, okay. That meeting will last for an hour. After that, what you will do? He said, no. I'm there for the whole day. I said, then you want to meet anybody else or you want to go? He said, no. We'll stay. Then after meeting Ramco Cements, instead of 1 hour, he took 2 hours. Then he said, I want to meet some competitors. So he went to the competitors. He went to Chettinad Cement and India Cement. Then we went to the dealers of the cement companies to find out, what is happening and all that. So then he wanted to, even he spoke to one lorry transport fellow also who used to take the cement and to the company from the factory to different places. So this is the kind of research people were doing. So of course we didn't have the means also to do this kind of research, but wherever we invested, whatever news was available anywhere, we used to try to keep noting it or keep jotting it out like that. This is what Kishan Choksi told me, this is what you should do. If you see his annual report, he'll be full of cuttings and paper cutting. Those days, no internet, no tuck, tuck, tuck like that, you know. So that is how it comes. And coming to a question of multi-baggers, see, nobody invests with a view that you're going to make a multi-bagger out of
so
a
you
stock.
don't know when you invest that it's
When
a
you
multi-bagger.
invest, see, take for example, Dr. Reddy's lab. It started with a market cap of 1.1 crores. And after that, it's 80,000 crores. If the promoters had known that it's going to be a multi-bagger, he will not come out to public also. So what we used to do is we used to invest in companies which are very, very promising growth in the next couple of years, and companies growing at 30% kind of thing, you know. So those kind of companies we keep investing. But sometimes what happens is if you buy a stock at 100 and you expect it will go to, let's say, 200, 300 in 2-3 years, market crashes due to some reason, you know. Along with the good, bad shares, even the good shares will come down. Now this 100 rupees becomes 60 rupees. At that time you should not panic. In the time of it's going down from 100 to 60, you should keep on studying more and more and making sure that your conviction is right, what you bought. Nothing is gone wrong with your fundamental philosophy, to the best of our knowledge, you know. And then at 60, you should buy truckload of shares. Then it goes to, in 3-4 years, it goes to 300, you make a 5-bagger. So that's how you make a multi-bagger. Multi-bagger is very difficult actually.
Got it. So coming back to the original COVID buying, so that is a very contrarian investment style, to bet against the market. So how does this contrarian investing work? Can we be a contrarian every time? Where does the to being with the flow versus contrarian, how do you rationalize between these two philosophies?
See, Naresh, being contrarian all the time is fatal actually.
All right.
Because you are going against the wave. You will get swept away, you know. There are some people, I know one guy, he's lost so much money now, he's left, he's gone to some village and all that. Because whatever happens, he says, becho. If there's too much buying, becho. Everybody says you buy. No. But you look at the trend, you know, when you're at the trends, at the extremes, nobody knows the exact top or exact bottom. But generally you will know the buying zone or selling zone. So at that zone, if you are a contrarian, you know, you will make a lot of money. And you may have to wait. Sometimes you also will suffer also, you know, because you can't, suppose if you bought a share and it goes up irrationally, you can't hold somebody's hands and say, look, don't buy, it's bad, like that. You know, they want to buy, so it will go up after you sell also.
True.
So that is basically contrarian thing. But sometimes also selling has helped also, you know, like you take for example Bosch. Now from 1980s, I used to go to Bangalore with Kisan Choksi and my uncle, and we used to visit the Bosch AGM. After the AGM, we have seen the plant also a couple of times. And it's one of the best companies in the world. Those days and even now. Okay, even today it's the best auto ancillary company in the world. But the price kept on going up and up and up. And finally, cost 20,000. So Chinmay and I, we were looking at our holdings, you know, because we had bought some 10 share, 20 share. Every time we used to go to AGM, I'll buy some shares. Chalo, ye acha hai. We'll buy it and keep it. You will not lose money in this. So we collected so many shares in that, and 20,000 was far beyond our imagination. Even 15, 16,000 itself, we found it is overpriced. For some reason, we didn't sell at that time. So from 20, we started selling. Slowly, because it's the best of the best companies. You are possessive. You don't want to sell all together, no? So it's slow, and you made so much money in the company. So slowly, we sold at 20, 21, 22. Finally, it reached 28,000. We completely sold out. We just left 5% of the shares. And that time, the market cap of the company was 80,000. So Chinmay, you know, he said that, okay, there are 6 Bosch companies. One of the companies and the market cap is so high. So we said, okay, we'll sell. And there's only good selling I've done in my whole career. The price after 8 years is also less. Otherwise, anything that I have sold, they've all gone.
So that also, I think, is a testimony of the kind of companies you bought. So that it keeps going up even after you sell. But understood. So I want to come to a long-term thinking. So Charlie Munger says big money is made not in buying or in selling, but in waiting and holding. So again, my own experience is that let's say war or a demon or anything happens, we look at which are the, let's get out and sell and raise some cash. So for example, the TVS Group company, I've seen you're holding more than 2% of the company for probably 15 years. What's the framework which made you hold on in spite of, and it's come, as I've seen, it has bounced back stronger after every challenge. So what makes you hold on to those winners in the face of major challenges which look imminent?
See, one of the most honest groups, in my opinion, in the country, if you have to rank top 3 groups, TVS Group is one such group. Okay, Sundaram Finance, Sundaram Fasteners, Sundaram Clayton, they've all rewarded the shareholders so much, and they're technologically very, very strong. You know, anybody who comes to a plant of Sundaram Clayton or Sundaram Fasteners becomes his client. He doesn't want to then go to anybody else. Second thing is, you know, they were slowly, they were one of the first groups to export also. So, am I audible?
Yeah.
Because some echo is coming. So they are also one of the first to export. They were the first to start radiator cap plant and all that. And the quality was so good that, you know, they've been getting General Motors award, every year supplier of the supplier award they used to get. All their plants have Deming award and all that. So everybody is happy, you know, shareholder is happy and customer is happy. Employees are so happy, you will not believe. The employees, they even don't talk about, chairman doesn't talk about his compensation. Only employees, they decide. And they say, okay, I think we'll go for this increment this year, not more. Once some unexpected holidays were there, the employees decided that we will work this time on this Saturday also. 3 Saturdays we'll work to compensate those 3 days loss. So this kind of commitment when you see in the employees, you know, and when you see this kind of management's attitude to employees. So these are all the strong attributes that, you know, we said, okay, this company is temporarily it may go up or down, but eventually they are good companies good businesses and good managements and good companies to stay on. These days it's a problem of plenty, but those days there were a lot of lorry strikes and all that. But a lorry going to a particular cement company, the lorry driver has a choice which cement company to go. He'll prefer only this cement company because I'm going there. I get a very nice resting area for 3-4 hours. I get very good meals and all that. They take good care of us. So all these things you will know when you visit the companies and visit the factories and all that.
So if they take care of the customers and employees and vendors, then I'm sure the shareholder gets taken care on its own.
Yeah.
Interesting. So I want to come to compounding. Einstein said that compounding is the 8th wonder of the world, and we have seen it in CAGRing, how it helps in wealth building. Does compounding also work in knowledge and in human connections as far as investing sphere is concerned? Do you think?
Certainly.
So
certainly it works. If you are going to, you know, your knowledge is, if you are going to keep spreading the knowledge, exchanging the knowledge with people, you definitely do much, much better. In the same way, as far as meeting people is concerned, the stock market, the new entrants, you should meet as many people as possible. You should visit as many factories as possible. Listen to everybody, but do what you want to do. You do your full homework and then you do what you want to do. So that is where the compounding works.
Interesting. Everybody makes mistakes. I'm sure you made very few in the course of your investing career, but are there anything which come to your mind, and have you learned anything from it, and how has it shaped your own growth by fixing those mistakes along the way?
You know, the mistakes that I made, like you have a hall of fame, no? There'll be a wall of shame. There are so many mistakes people make, and people are bound to make mistakes. Somebody says that in the last 45 years, 42 years, I have not made a single mistake. He's lying. Mistakes are bound to happen because this is such a very dynamic and active, investing is a very active process, So mistakes you make. But you should not make mistakes which are blunders, which will take you out of the market completely. So if I have to list down, I can list down 25, but I'll list down 1 or 2 or 3 maybe. So the first mistake I did, I short sold Ingersoll Rand in those days. There was a Badla system in Bombay. So one of the executives was our client and he sold his shares. So, and he bought Colgate with that money. So I didn't bother to analyze, but because he has sold, it is bad. So I also sold. And this is an example for all the youngsters. Don't listen to people and immediately come to a judgment, So I also sold, I short sold that and then I lost very heavily. Then I decided that I will not short sell anytime in life. Because when you sell, you can even lose infinity. When you buy only, you lose the cost of what you have paid for. The other mistake I did, it's a very silly mistake, but Infosys public issue was happening. So I had gone to Bombay to attend the IPO meeting. And after that, that time, Mr. Manek Bansali, Vallabh Bansali's brother, INAM had managed the issue. So he gave me one form for 500 shares. Fill it up. Don't have to, you get the shares, you don't have to sell for 1 year or something. I came happily. Issue was at 95 rupees. So I filled up. I was about to submit it. That evening, Vinod Sethi came. Vinod Sethi was
the Capital Group.
He was Morgan Stanley.
Stanley.
He was like God. Even now, he's a great investor and he's a great guy. I didn't know him very well, but he invited a couple of brokers, including me, 4 or 5 of us in Park Sheraton. And as we were having dinner, suddenly a phone call came. Infosys issue is bombed. He was so happy. Those days no cell phone. So he attended the phone. Infosys issue is bombed. Oh, so happy. He looked very happy. And I didn't have the courage to ask him, I have some shares. I'm going to apply the shares tomorrow. Why you're so happy the issue is bombed? I didn't ask him anything. I quietly decided, which is a very wrong thing to do. I said, I will not apply. So I called up Mane Babu and said, I don't want. I'll send you the form back. Subsequently, I met Vinod and he told me that he had a deal with INAM and with the company that if issue bombs, all the unsubscribed portion, he will take it. Oh. So that is a big mistake. I mean, but okay, these mistakes are such that, you don't lose your shirt in that, but it's a kind of thing to learn that, don't get carried away. Very recently, about 10 years back, very recent for me is 10 years.
So that's the decadal experience coming.
So about 10, 15, I don't know when. TTK Prestige used to be 15 rupees. So we, Ashok Vishwanathan, friend of mine, and we started buying. A very, very cheap stock. And price went up quite a lot. It went up to 35, 40, 45. And then all Utpal and all Rakesh's team, they came. We discussed the company with them. They bought 1% of the shares.
Wow.
Because of their buying price went to 80, 90, 100. One friend of mine, he was in one of the group companies in TTK. He was also heading a group company. So I casually asked him, boss, how is this company? He said, I also bought some shares. Very good. Okay. I can't buy through you because we have our rules. But it's a very good company. After 160, we gave 200 in about 15 days.
Wow.
So again, I met him because we had a lot of shares. All our clients had shares. So he said, look, I have sold off my shares. But the company is doing very well. I said, can you find out? I said, our policy is I can't ask the MD of TTK that tell me what your company is doing. I know everything. He has to tell you. But I'll give you a letter. You go to Bangalore, meet him. He will tell you, you are a long-term investor. He'll explain you the company and all that. I was lazy to go there. Okay. And my friend said, I have sold because I don't know anything about the stock market. I'm making a Europe trip with my wife. So he said, I'm very happy.
Is the friend heading another TTK?
He was heading another
TTK
group company. So he said that I'm happy. I made more than my annual salary, he said. So I'm content, I'm very happy. And see, I should have at least gone, because reports were coming that they are doing very well. Our good friend Shyam is here or not, I don't know. Shyam also, he was also very strongly recommending.
Sir, I think held probably more than 1%.
Unfortunately, I didn't know him then. Otherwise, I would have not sold. But a lot of people told me not to sell. But then I said, no, this guy has sold his shares. He's not a fool. If he has sold, we should sell. So all the 1,45,000 shares or something, everything we sold off. Some 20,000 was in US, my son's name. I sent him some, he was doing PhD. It took some time for the papers to come and that got delayed. So I got some 350, 400 by the time it came. And we made all our clients also sell. In honest to this thing, that boss, it is good to sell. And after that, over years, it went to 9,000, 10,000 bucks. So this kind of mistakes, you have to do your work much. Very recently, we sold companies which we knew so well. Tube investment, we sold at 800 rupees. It became 3,000 rupees now. Chinmay had worked for 2 years in the company also. They were long back.
Before this
Carnegie Mellon, this thing. So, mistakes are there, but only thing is you make mistakes. These are mistakes which are loss in profit. You should not make mistakes which will be so painful that you have to break your fixed deposits and you have to cut short your thing. That is one thing people should avoid, I feel.
Going right to make from 15 to 300, 400, anybody would be happy to make those mistakes.
Sorry. Other thing is, this is one problem. When a stock appreciates too fast, you are so much nervous. We are very nervous, We think, it can't be. When it goes up so steeply, because anything which is doubling in 3 years is good, and this is doubling in, many times happening in a couple of years. So you want a reason to sell. You just don't want to do, no reasoning is required. You just want reason, somebody says, okay, I'm happy I sell. That's another mistake.
Very interesting. So there's a Greek mythology by the name Milo, where someone builds strength to lift an ox. First he lifts a calf, and then every day he lifts it and becomes strong enough to lift an ox. So as I see, like you've grown your portfolio, how many 100x or whatever, so it's a phenomenal growth. How have you built the mental capacity to handle? That's a problem I'm hoping a lot of us would face, that to handle increasingly large portfolios ourselves. Your portfolio is probably bigger than a lot of PMS schemes or mutual fund schemes. How have you built the mental strength and capacity to increasingly handle this larger portfolios?
See, by God's grace, the portfolios have gone up because of our luck and laziness both. Some of the shares we didn't sell and they've appreciated quite a lot. But yeah, once you reach a decent size and you have all your expenses met, all your emergency money is also there with you. Your son's education, your daughter's wedding, and everything has been taken. Everything is, you have made that much money and still more. The additional money which you have put in good blue chip companies. At that time, your idea should be to protect the capital. Investing is preserving. It is not just making money at that stage. So you should also only invest where you will not lose. Okay, and if you have 20, 30 counters, somebody says buy this, you buy this, you buy this, then your focus is going on smaller things, So that is one thing you should avoid. So when you are going to do this, and at this higher level, you should only think of, first thing is protect the money, and second thing is see that you don't lose much, and third thing is look for 15% compounding. Let's say if 15, 20% certain compounding it appears, in bad markets so many opportunities come, everybody panics including us, nobody is spared. But if you look at something which is short going up, like Bajaj Finance came down from 10,000 or 8,000 to 1,800 during COVID. that kind of thing. So if you look, you should look at only that kind of 15% compounding kind of thing. But make sure that you don't lose money. In the worst case, you can have a drawdown of 20, 30, 40%, but not
a
permanent, a big drawdown, because it's very nice when you make money, but it's very bad, much more bad when you lose money. You know. So from higher level, if the whole thing crashes, because we realized that in 2008, we were not keeping any cash. So our portfolio came down from 100 to 20 or 25.
80% drawdown.
Market 75 to 80%. Market was not that bad, and all our shares were not that bad. Our shares were very good shares, very good companies, but very illiquid. So illiquid stock, there's no buyer. You are buying at this price, you take it. You name the price and you get the price. So having seen that, I think it is very essential if you have a bigger portfolio to keep cash. I think you have been doing it. I told Khannaji also, though he's my guru, I also told him that you should keep the cash always. You know.
So is that your bear market buying power?
Yeah, I mean, see, in selling, what happens is people generally don't want to sell. You know, they're very
possessive about our shares.
And also, you know, after selling, the main question comes to somebody is, I have to immediately buy. I can't keep cash with me. Because everybody generally have seen, you know, my money is lying waste. Why it should be lying waste? But sometimes that 10% cash which you have got, if a market crashes in a big way, you can deploy that money. Like from COVID, some of the shares have gone 4-5 times. So keeping that 10%, we didn't deploy fully, we deployed only 70%. But that 5x, if it's going to give you, overall your keeping 10% has not harmed you.
In fact, it moves the entire
return. We call it a very strong asset you create by selling stocks, called bear market buying power. So that is one thing, and we always do that. You know.
Interesting. Coming to the current global uncertainty, so there is a lot of talk of inflation, global slowdown. There's a war going on. So how do you see that impacting Indian economy and Indian markets? How are you taking that in stride in terms of your investment philosophy and strategy?
I think next 1 year may be little uncertain for India also. But I think next 10 years, we are going to do extremely well. 5 to 10 years, I'm very, very sure about it. Our per capita income may go from $2,000 now to about $5,000 in 10 years. And most of the big countries, as of now, they are under recession, and they are going to be under recession. US, Europe, UK, Japan, all of them, Korea, everybody is in trouble. Mm-hmm. So a lot of manufacturing-led growth will come to India. A lot of, so many other sectors will do well.
So it's world plus one, China plus one.
And somebody was saying now it is not even China plus one. They are saying China is zero. Okay. We don't want China.
All right.
Because you invest in a country and you can't take out money, who is going to invest? So PLI scheme and all these things, government has done some fantastic work, but I hope everything goes in the same smooth way. The biggest joker in the pack is the next year election. You know, we don't know. Otherwise, I think our exports are going to do very well in future, in times to come. And, you know, now, main thing what has happened is in Europe, because of the gas problem, because of the war, Russia-Ukraine war, the gas is more given to the households. There's no much gas available to the industry. Not now, a couple of months back. So now, some of the big companies, they are global leaders. They give everywhere in the world. So they have given the work to be done to countries like India.
The Indian subsidiaries.
Indian subsidiaries like SKF Baring. Timken, they gave 2 products to be made in India, to be supplied to the whole world. So when these kind of people, this kind of thing come, and there are a lot of Indian companies, Bharat Forge, Sundaram Fasteners, you know, a lot of subsidiaries of companies like Wapco, Bosch, they'll all get tremendous amount of work. And India. It will lead to a lot of, you know, big development.
So it's more of, it's like a structural India story, but with probably some hiccups due to these temporary challenges what we have.
Yeah, I mean, market valuation wise, it's not cheap. today. And at least not cheap to our liking. I won't say it is a 100% sales zone, but it's not a
compelling buy zone.
Nowhere near compelling buy zone.
Got it. So in closing, if someone like, we have a young friend from Hyderabad, Alad, my friend's son, if he were to come and approach you, he's just a budding investor, probably 20 years of age, what advice would you give him because he's just starting off as a budding investor? What would you tell him?
Where is he?
Alad is here, yeah.
He and his colleague also, no?
Rishi, yeah. If both of you were to come.
Yeah, I must thank you guys, man. At the age of 20, you come to listen to a talk like this from your student age.
Not just
you
this,
go in the right age. And even my nephew also, Ram, he's of course older. He's an engineer and he's also come to India now. He's also an investor. So all these guys, if you go in the right way, this is the right age to invest. And I think you guys will do extremely well if you really don't go for very shortcuts. Okay, this is a very long game. Stock market investing is a very long game. First of all, primarily I will say everybody should be very humble in the market. Otherwise, stock market will humble anybody and everybody, We have seen in the past. I used to know Harshad Mehta personally very well.
Wow.
Okay. See the way the fall has happened. Like lot of people, lot of big guys have fallen, like that. So, you have to be humble in the market. Never think that, you can take the market, you can steer the market. Market on the whole is much bigger than any individual. So that one thing you should keep it in mind. The second thing is you should do a lot of, you should try to learn, keep learning. Learning is a very active process. There's no end to it. Even if you are 65 or even if you are 80, I'm 65, my Guruji Kishan Bhai is 85. I stay with him when I go to Bombay. In the morning, he is up before me on the tea table. He is looking at the newspaper and he is underlining everything at the age of 85. And he told me, did you see this company's report came 2 days back in the Economic Times? I said, yeah. When I saw, no, are you sure? I said, I'll see it. Okay. Next day when I'm sitting on the table, that newspaper cutting is ready.
2-day-old paper.
2-day-old paper, he's kept it ready for me to read, you see. Today also he reads every day, one annual report he reads. And most of the annual general meetings he will attend physically. So learning is a very active process. You should never stop learning. So that is one very important thing in the market. And other than that, I think, you invest with a long-term view and, try to see that you don't, you may make mistakes. It's not that you don't make mistakes. You should also note down. I strongly recommend all of you, all youngsters, to read a book called Richer, Wiser, Happier by William Green. That book, it gives history of all the top investors in the world. What they have done what happened during war at that time. John Templeton, during war, he bought 104 stocks. It was such a pathetic situation, and he bought 104 different stocks for $100 each. And when the war ended, 98 out of 104 went up very steeply. So you should know all this, So history is also very important. And I don't know what else. Nothing is striking me now, but basically it's good that, you take interest. It's a very, very interesting field. See, if you're going to be working in a particular company, automobile company, you know about automobile. Okay. If you're working in a software company, you know about software. But if you are in a stock market investing, you know almost all the industries. You have access to all the industries, and you should also have the fire under the belly. You should really want to go more and more deep. And you're all quite fortunate that you have, today internet is available. Anything and everything you can find out what is happening anywhere in the world like that. In those days, in the AGMs used to be, once we went to all the way from here to Bangalore. From Bangalore, we took ambassador car, drove 4.5 hours to a place called Hindupur for a factory, LG tire factory, the annual general meeting. Because they don't speak, so we thought in the AGM they'll speak. And the chairman said, we are doing very well. You came all the way from Madras. What is that? Since you have come, please have your food, go and go. That was the those were the days, for AGMs. So now, I mean, you have a lot of access. Also, one other important thing is that the market has become very, very broad now. In those days, you know, it was not so much researched. Today, the market is so very well researched that if you are going to invest in a company, you should have a much longer, you should get in much before everybody else. The success in stock market investing is only you should be ahead of others. Either you buy ahead of others or you sell ahead of others. You know, so if a company is going to give a bad result and one quarter is going to be bad, but you know that the next 2-3 years it's going to do extremely well, then start buying now, because when bad result comes, you will not get shares. So that is one thing I forgot to tell you that. But I think India has got a very bright future, and only thing is you should have patience and you should have a lot of discipline to invest. You should have conviction. You should try to read as much as possible, try to meet as many people as possible, and also don't listen to anybody and act immediately. Don't be in a hurry to make quick money. You don't have to prove to your parents that you have made very big money, you are very fast like that, or your friends. You try to learn. That is what I advise children.
Malad and Rishi were at our office also yesterday. So they were talking about companies and they had all the information on whatever companies they've done. So in fact, me and Prajesh, we were thinking, it is going to be difficult with such smart youngsters coming up. They're doing phenomenal work. So thank you, Govind, for the advice. We'll shift to Q&A from the audience. So anybody having questions, feel free to. There's a hand going up there. Is there a mic going around?
Yes.
Yeah, pleasure listening to you, sir. My question is, what are your views on technical analysis? The concept of techno funda, where the first filter is your business analysis, where you hold on, where you screen the stocks through your fundamental analysis. Then you add when they give a breakout or following various strategies. So what is your view on techno funda?
See, I haven't followed much technical analysis. I know a little bit of it, having been for donkey's years in the market. But I think first thing is you should know what to buy. Technical analysis tells you when to buy. But what to buy is important. So fundamentally, you should know whether the company is good enough to buy or sell. And if you are a very long-term investor, technical analysis helps you when you really want to build up a big position. Then whether at this particular point there could be some selling, so you can wait for some time and buy like that. Otherwise, I'm not much for that technique. I'm not an expert in that.
Thank you.
Hello, it was really great to hear you. I mean, you had actually mentioned that now everybody has access to all the information, right? So, and earlier in those days, you have to travel far and wide to attend AGMs. Don't you think that that all of us having information has made it a lot harder? Because now the actual barrier to entry is so low, right? I mean, so I would really like to hear your views on that aspect.
You're right, that's a good question actually. But the pie has become so big. You see, in spite of, the market being so much researched, there are always opportunities. And there are opportunities when some chaotic situation happens, Like suppose oil goes to 150 in a month's time, let us say. It'll be a doomsday for most of the companies, but it's not going to stay at that time. So in spite of knowing fully well that it's not going to be, it may come down, you can slowly start investing in when the market falls at that, and wait for a long term. For a long term investor, it doesn't make difference. If you have bought, let us say, a Dr. Reddy at 200 or at 2000, it doesn't make a difference because the price went to some 2 lakhs or 1.5 lakhs or something, bonus adjusted. So that way, a lot of information is there. It is no doubt people know. But then, as I told, you should be ahead of others, So that's what will help you. If you really concentrate on any particular stock and You know that one quarter is bad. That information may be slowly trickling out, but you know that it's going to be bad and you know that the market is going to come down after that. But you should buy because the next 2-3 years are good. So you start buying from now and keep buying into it till it goes up.
Yeah. Akash.
Akash, I'm scared when you ask me questions.
Some very basic questions. So,
Not out of syllabus.
So I just want to understand how you adjusted your thought process, right? When you started, you were buying companies with 3 or 4 times P, consumer companies, TTK Prestige, 1 time P, right? Let's forget the crashes, right? That's once in a decade kind of a thing, right? COVID or 2008. Now you will never get a TTK at less than 25, 30 times P, right? So the adjustment from someone who started off buying companies at single multiples to now the same companies regularly trading at 30 times P, 40 times P. How do you adjust and how do you still keep investing? Because that becomes a lot of, you are used to a certain, you are comfortable at a certain valuation range everything has changed now.
No, I get your question. Actually, what has happened is, you can't stick in the stock market, nothing is permanent. Okay. It will keep changing. So you have to also change with the times. In those days, 2-3 multiples, you were getting stocks. Today, you don't get. But don't forget, today the awareness in the market is so much. The players in the market are so many that even if you pay higher PE, still you'll make money. At least if you are not looking at a multi-bagger, if you are looking at steady compounding of 15-20%, it's possible. Even very big companies like HDFC Bank also, they are also doing well, Kotak Bank, if you are really planning to keep it for 5-6 years, perhaps. I'm not recommending it. I don't have any. I have some, but perhaps it can also become, go at 15%. Pie has become very big. And especially after COVID, what has happened is, not after COVID, actually when demand took place, a lot of people had a lot of cash. In Indian society, it was accepted norm. Traders, small-scale manufacturers, everybody had cash from 25 lakhs to 500 crores. All small companies were there. Everybody was having a lot of cash also with their wealth, along with the white. Now, after demand, our people are very smart. They got everything converted into white. Now, they are sitting with a lot of money, a lot of white money. And bank rates were very low. And COVID took place. So, everybody is watching CNBC and laptop and trading in the market. And they found that the value rates were so low and they're making some money. And these are all smart guys, not dumb money. Very smart in their own businesses. But the businesses have gone. The small scale industries, many of them, Sudhir bhai may also know, a lot of people have closed down. A lot of pharmacy, big pharmacy people, they've closed down now. Because of e-commerce, it has made a lot of changes in the market. So all these guys, they've been investing in the market. Plus, the big guys have become so big. Like our Chandakji will know, the big companies, how big they become, what they were a couple of years back and what they are now. So they become so big that they have lots of money with them. So they have got their family offices which are investing in the market. So you should equate your thinking 25 years back or 40 years back when you're looking at 1-2 multiple. Today you look at 20 multiple and all that. And today the awareness is so high that even if a big family office is having 30, 40,000, 50,000 crores kind of money, even if the money, they'll be happy to double the money in 5 years. That is 15% compounding. So, they don't mind paying a 25 times multiple instead of 15 times multiple for a growing company with very clear prospects and good managements ahead. So that is what it has changed now. So that's how we've also changed.
Yeah, someone there.
So,
please go ahead.
Yeah. You spoke a lot on the sort of temperament one may need, right? To be patient, to be humble, right? To do the hard work and go visit the factory rather than take shortcuts and all. So is it that there are some people who could be good at this, and then there are some people for which this is not the right place, right? Is it something that, do you get the signs that this is not for you and you're better off cutting your tenure there and finding some other thing to do?
You mean some managements?
No, as an individual investors to say that this is not for me, I better find a professional to manage this, or you find that I have the right temperament, or I'm able to build the right temperament and do it myself.
No, basically if you have a lot of money and you're not an expert and you feel that you cannot visit the company and do all the things, you can always rely on some good mutual funds and put money in them, which will be also very good. The mutual fund culture also developed quite a lot. So a lot of people are managing money, PMSs and all that, So you can give some money there also. You can try out. Only thing is, don't go by the past record, because somebody has done very well in the 10 years, the 11th year he may do very badly. So just because he's done good for 10 years, it doesn't mean you give him all the money. So you just spread it out into few other people and do it. That's what I feel.
Yeah, please go ahead.
Hello. Sir, thanks for your insights. Like, I have some questions. Like, one is, during buying shares, like we do value investing, whether the share is underpriced, but at the time of selling, like, how do we get that mindset to sell if it is continuously that market is increasing? Like, that's what you said, right? So at that point of time, still we do whether the share is how would we decide the selling point? Like, how you do that? That is one question. And one more is like portfolio allocation. Like, how do you hedge your because market is risky, there is uncertainty. So how do you allocate your how do you hedge in gold, or what is the optimal allocation? That is one point. And what is your thought about IPO investing? Because when a company is going for initial public offering, so how do you value that? Is it safe? So because some are very overpriced, so overvalued. So these questions I want to know, sir.
3 questions, all 3 billion questions.
Thank you.
The first question is buying. Of course, we do a lot of research. You people, most of you are CFAs, so we rely on you guys, CAs and CFAs. So buying is easy. But the selling, normally, you should sell when you don't see anything bad. Something you should sell. So you keep a target when you buy a share that, okay, I'm buying at 100. It should become 200 in 3 years. Okay, if it goes to 180 in 1 year, you should strongly evaluate, whether it's still worth keeping it for another 2 years, or maybe you sell it at that price, wait, keep cash, buy again for something else which is at 100. That way you can maximize the money. This is when you're initially investing, And you buy in good times. Don't always wait. A lot of people I have seen I also do that. You don't sell. When the market starts going down, then only you sell. The people advise, some very wise investors also, Abhi kya besne ka hai? Let the market go up, let it start coming down, then we'll sell. See, that is the wrong thing to do. When you are nearly at, we don't know the top, but when you are at 70-80% of the top, you should 70-80% of the top, you should definitely sell it off. You start selling at least. Don't wait for the 100% thing, because if you wait for it and if it starts coming down, you're not the only one to sell. There are many, many people who want to sell along with you. So there's a competition, and then you may be surprised that you will not even get 70 rupees. It may come down more also. So selling is actually very difficult, and so many times we coined a phrase, sell, regret and grow rich. So if you're bought at 100 and if it goes to 180 and you sell, it goes to 220, it's okay, you regret for some time, but eventually some crash happens, it may come down to 100. So selling is that way. It's not easy to master by anybody to sell at the right time. So you should be a little bit liberal, in letting other people make money. Somebody has sold you shares at 100, no? So at 180, let somebody else also buy and make money. In that attitude, it's very easy to advise. I don't follow on, please. But that is about selling the thing. The second,
allocation. Next one was on the portfolio allocation.
Yeah, portfolio allocation. We have only cash is our hedge. Nothing else is our hedge. We have some flats which we stay, and otherwise we never invested in gold also, in spite of my wife not liking it. But only cash we keep, and when market corrects a big way, we deploy that cash into the shares.
Maybe have last 2 questions. So, yes, go ahead.
Yeah. Sensex had a lost decade from 93 to 2003. So how do you stay disciplined and motivated when the market is going sideways for a long period of time?
It's true, actually. Market was in a very, very bad stage at the time. We all used to sit in my office and play chess. We were all my friends. We were during market hours, and but only thing is, at that time there are some stocks which really did extremely well, even in the bad times. So if you take shares like MRF, if you take shares like McDowell in those days, now it is United Spirits. If you take shares like Dr. Reddy's, if you take so many of these companies, they did phenomenally well during that period. So the overall market, even if it is bad, if you are sure of the company, your companies will also be available very cheap, which you want to buy. So you keep buying those companies and keep waiting. Even there's nothing you can do. Japan was in bad shape for like 30 years.
89 till probably.
Yeah. What Japanese index was there in 89, even 2009.
Today, no, even today, from 40,000, probably it's
never
little
come,
below.
that index. So it's like that. Of course, period was very bad, but then you have to find out whatever possible things are. As far as possible, you should cut your costs at that time. So this kind of a passion is there with people. So bad times, you should really introspect, and you should try to see that you always, bad times don't last. Especially in India, I think it's not going to be like Japan for 30 years and all that. Always good times will come. Any bad government comes also, it will be temporary. If the government is not supporting industrial production, government is not supporting growth, the government will have to change. That's what has happened in the past.
So this last decade made you build a portfolio of great companies. And how was the next decade, post the 2003, on the portfolio you built?
It is a continuous process. We keep churning also. Some of the shares we keep churning. Some shares we don't want to sell those, so we hang on to them.
Got it.
They're sleeping points, so.
Take one last question.
Sir,
maybe two,
That young man also should ask one.
Sir, you spoke about adding, a position when some of the stock corrected, and you had your work and you had a conviction you added. But can you share some example in terms of averaging up? When you bought something, it kept doing well. You bought it 100, now prices moved to 180, but you would have added because the story is turning out to be what you would have thought.
It's a very good question, but it's hitting me on my nail because I'm very bad at that. I can buy if it comes down, but once I buy, I'm lazy actually to rework and buy more at higher prices. So that has been one of the, what shall I say, the bad investment ideas. We never did that actually. It's very difficult to do that.
Yeah, I think it's a matter of individual style. We have Khanna sir who will average up and do very well on that. So you had.
So first of all, thank you, sir, for all the wisdom you've shared with us regarding how we can get started. And my question to you would be, where would you draw the fine line between risk and uncertainty? And also, since you have mentioned about capital preservation, has there ever been a situation in which you have been convinced to take a risk, keeping that motto aside, and in the future, if there will ever be a situation that will compel you to do the same?
See, basically, the risk and reward, they are always, the higher you want to take the reward, the greater you have to take the risk. So what did you say, the fine line between the?
Risk and uncertainty. How do you differentiate them?
You can't actually differentiate between the uncertainty and risk actually. The risk is always there. The capital preservation comes when you have a lot of capital. When you have built up a lot of capital, then you can't afford to lose that, because what you have made over so many years it's become sizable. One fine day, if you lose 30% of that, it really hits you, no? So that you can't do.
What's your next one on?
The first one was on like what is the difference between risk and uncertainty? The second one was is there any like situation that you wanted to take a risk despite wanting to preserve your capital?
Took extra risk because maybe it was very compelling.
Yeah, see that we do so many times. We've been following a particular share, let's say, and it crashes in a big way. And normally for that company and that management, maybe I will allocate X crore of rupees. But the valuation is so compelling, it is wrongly priced in the market. So we try to buy as many as possible with a clear thinking that whatever extra we have bought, when the market realizes the potential and it equalizes and comes back to normal, we should sell that. Although we know it is the best of the best stock, still we should sell. Because the risk is, you cannot have all the eggs in one basket. Though there are some people who do it. They have only 5 stocks. But we are not that confident and expert to, have all the 5 right. Even if 2 go wrong, the whole portfolio becomes shabby then. So that is the thing,
Govind bhai, sorry. One, what you mentioned right now about risk management, my question is related to that only. How do you allocate to various businesses in your portfolio, and how many do you have at any particular time? Are there any upper limits that you manage, you kind of keep to manage your risk? Any rebalancings? You mentioned something when you bought more and market realizes the potential, you cut down. Do you follow any quantitative limits there in terms of percentages? How do you manage your risk?
Normally, we don't exceed more than 10% in any company of our portfolio. And number of shares we have is about, we have more number, because I was a stockbroker in those days, so a lot of shares would have come as bad delivery and remained and all that. And we are lazy to clean up that. But the majority of our investment is in the first 30 companies, about 90%. And 80% will have first 20 companies. So, sometimes you don't allocate more, but the price of the stock goes up so high that it becomes not balanced. So, in fact, my largest holding, also I sold some shares and I told chairman that it has become lopsided. My position. So
chairman of the company.
Of the company, I told him, because you say, you are thinking I'm a long-term investor. I am. But the price has come down, and from there it has gone up so much, and now compared to my portfolio, this is the biggest. So we trim some shares there.
So what is that percentage where you feel uncomfortable beyond?
Not like some companies, like sort of we are married to, so we don't sell. It's not that nothing rational about it. We like those companies, we like those managements, and we say, okay, ek do saal not going to be good, but afterwards things will be good. We have hope. We are remaining invested on hope, not on proper analysis.
And within, say, various businesses, how do you decide which one to allocate more? Do you look at the potential upside, or you look at minimum downside and allocate more to those?
First of all, we don't look at how much money we'll make. We make sure that how much money we don't lose. That is even during COVID. Only thing Chinmay and I were saying is, okay, boss, how much money we lose from here? I don't care about how much money I'm going to make. How much money I'm not going to lose? I'm not going to lose much from these levels. So that is always there. We always make sure that you look at what is the probable downside. Most important investing principle, what I've read, is you should see how much is the probable downside. Let the upside ride,